In the 1990s, George Soros stood at the front. Behind him was not one man, but an entire method of global capital attack. The same playbook, used again and again, pushing different countries step by step to the edge of collapse. It had no ideology, no emotion. It focused on one question only: which financial defense line will break first? The reason this method worked so often comes down to one economic rule: the Mundell impossible Trinity. You only need to remember one sentence. A country can choose at most two of the following three: a stable exchange rate, free movement of capital, and an independent monetary policy. If you insist on all three, the market will force you to give one up. When the market starts dumping your currency, your central bank is pushed into a brutal choice. You can burn foreign exchange reserves to defend it. You can raise interest rates to extreme levels, or you can abandon your exchange rate promise, which means admitting one thing: this price cannot be defended anymore. Soros's tactic was simple. He looked for the weakest corner of that triangle, then applied maximum pressure. Relentless selling, reserve depletion, interest rates pushed to the ceiling, until governments changed their own words. Europe was the testing ground. Britain was the first bone to crack. In the early 1990s, the British economy was already weakening. Property prices were falling. Unemployment was rising. Under normal conditions, Britain should have cut interest rates. But to stay inside the European exchange rate mechanism, it was forced to keep rates high. The economy worsened. Confidence collapsed. The pound came under attack. As selling intensified, the Bank of England stepped in. Foreign exchange reserves began to drain at a frightening speed. Within weeks, Britain spent roughly $27 billion defending the pound. Still not enough. In September 1992, the central bank raised interest rates twice in a single day, from 10% to 15%. It was a move of desperation. The market did not blink. Britain ran out of ammunition. At night, the government announced its exit from the exchange rate mechanism. The pound collapsed. Asset prices were repriced overnight. Households saw savings, pensions, and property values shrink. History remembers it as Black Wednesday. Public estimates commonly show Soros making close to $1 billion on the pound alone. That year, his funds earned roughly $20 billion, with returns near 67%. The blade was sharpened. Asia came next. And this time, it was not a single strike. It was a sweep. The first target was Thailand. For years, Thailand fixed the baht to the US dollar at roughly 25 to 1. When the dollar was weak, Thailand thrived. Exports surged. Growth exploded. From 1986 to 1994, exports grew over 20% per year, and GDP growth averaged nearly 9.5%. Capital flooded in. Real estate, stocks, speculation everywhere. Then the world changed. After 1993, the US economy recovered. The dollar strengthened. Because the baht was tied to the dollar, it strengthened too. Exports lost competitiveness. Foreign income slowed. Normally, a currency would devalue to relieve pressure, but the fixed rate system did not allow it. So Thailand chose another path. Interest rates were raised. Capital controls were loosened. Foreign money was welcomed. Money arrived. But it did not build factories. It poured into property and equities. Between 1993 and 1996, Thai real estate prices rose nearly fourfold. Under the surface, foreign currency debt piled up. By early 1997, Thailand's foreign exchange reserves stood near $30 billion. Short-term foreign debt was at similar levels, meaning one thing: if capital fled, Thailand could not defend itself. Soros knew it. The same strategy began. Massive borrowing of baht, heavy selling, conversion into dollars. The central bank fought back. Reserves burned. Rates spiked. Every day of defense cost real money. By June 1997, most of Thailand's reserves were gone. On July 2nd, the government gave up the fixed rate. The baht collapsed more than 30% in a single day. Within weeks, it lost over 60% of its value. Property markets imploded. Banks failed. Companies collapsed. Unemployment surged. Middle-class wealth was erased. Families drowned in dollar-denominated debt, and capital did not stop. Thailand was only the opening cut. The same structure existed across Southeast Asia, Indonesia, Malaysia, the Philippines, South Korea. Currencies fell one by one. Central banks repeated the same ritual. Raise rates, burn reserves, strangle growth. The results were devastating. Living costs exploded overnight. Food, fuel, and medicine became unaffordable. Businesses shut down. Social unrest spread. In some places, despair turned fatal. By 1998, the International Monetary Fund stepped in. Rescue packages exceeded $100 billion. But recovery took years. Some economies needed more than a decade to stabilize. Others never fully recovered. Looking back, this was not magic. It was a mechanical outcome of the impossible Trinity. fixed exchange rates, free capital flows, limited reserves. Once targeted, defense meant bleeding dry. Britain burned reserves, Thailand burned reserves, Southeast Asia burned reserves, then came Hong Kong. Same pressure, same tactics, but for the first time, the outcome was different, because this time, someone acted from behind the curtain. Beijing mobilized sovereign-level foreign exchange power to support Hong Kong. The defense line held, the hunt failed, and that is where the story turns. Next episode, the Hong Kong defense.